farmland and the agricultural industry at large is a compelling investment opportunity right now for several reasons. First of all, there is growing global population, growing economic development, and all these things combine to paint a picture where there's ever-increasing demand for not only food, but quality of food, especially protein consumption is rising. Another big driver of agricultural demand and need for investment in the space is that many studies show that over a quarter of the world's population, about 29% of the world's population, is estimated to live in either moderate or severe food insecurity right now. And so again, there is tremendous need to invest in increasing food production. Another reason to be bullish on farmland in particular over the long term is simply the fact that there's less and less farmland all the time. They're not making new farmland. In fact, farmland is declining primarily due to the fact that alternative uses are being used. So for example, farmland is being turned into residential land. In fact, near where I live, that's happening. You see lots of farmland fields that were previously growing crops turning into home developments. You also see a lot of these farmlands turning into solar farms. People can get a higher yield by selling the land and putting solar panels on it, or just renting out the land to put solar panels on it instead of using it to grow crops. And so again, the amount of farmland is decreasing as other uses come in and making the remaining farmland increasingly valuable and driving the need to invest in technology and crop nutrition to drive the yields of those properties. And so this creates an environment where farmland can be very attractive over the long term. For one, it's fairly technologically disruption proof, right? I mean, you can have all these new technologies, you can come up with different agricultural techniques, and sure, those help increase agricultural production. But at the end of the day, you're always going to need some land to grow crops on and to have cattle and other livestock on to produce products, agricultural products. And so especially as the supply of farmland decreases, that provides a natural safe haven, a natural moat for existing quality farmland, and likely will drive its value higher. You also have inflationary forces, just increase in money supply, other forces driving inflation that, again, are going to drive up strong appreciation over the long term for farmland and keep it from crashing in value really anytime soon. That's been seen throughout history, that farmland values have been some of the most stable in history for different asset classes, simply due to the fact that there's such a steady demand for it, and it's likely going to always be around. It's also very recession resistant, or proof people don't stop eating just because we're in a recession. So again, there's always going to be need for it, always demand for it. That really helps. It also, is very easy to switch from tenant to tenant. So again, if you sell your property to someone else, or your current tenant goes out of business, it's very easy to release it to someone else. You don't have to repurpose the property. You don't have to do all this construction work. Just hand it off to the next one. Also has very low CapEx needs. And finally, it also throws off passive income. So in addition to being a stable store of value, in fact, appreciating over time as an inflation hedge, it's also going to throw off cash flow to you because you rent it out or you grow crops on it, or you raise livestock on it. All those things produce cash flow. You can come dual uses where you could have some solar panels and grow some crops, or however you choose to go about it. But it generates passive income. And again, that passive income should increase over time because due to the inflation driving up the price of the commodities that you're producing on it, as well as the fact that technology advancements are increasing the yields on that land, and the value of what it produces increases as the amount of farmland shrinks. So for all those reasons, farmland is a very promising and compelling investment opportunity. In the rest of this video, I'm going to talk about two opportunities that I think are really attractive in the farmland space right now. In fact, their prices have been beaten down significantly recently, making them very compelling, both from, they pay a passive dividend yield, but they also have significant upside potential involved. Before I get into those ideas, if you could please give this video a like, it would really help me increase its distribution, help me grow my channel. Thank you so much. Okay, the first idea I'm going to share with you is a real estate investment trust. It's called Farmland Partners. It's ticker symbol FPI. I think it's one of the most compelling opportunities in the entire REIT space today, but especially given what I just said about farmland. The bottom line with FPI is that it trades at about a 20% discount to what analysts' consensus net asset value, or the value of the underlying real estate, if you just own the physical real estate, net of the debt and other obligations, what you would get. So the current stock price trades at that massive discount. So it's like buying a diversified portfolio of quality, professionally managed farmland at a 20% discount, or 80 cents on the dollar. Incredible deal, right? Of course, the market is often inefficient, which I think it is here, but it's not stupid. And there are reasons for this. One is simply the fact that if you look at the stock chart for FPI over the long term, hasn't generated nearly the amount of value as it should have if you just held underlying farmland. And there are many reasons for that. One is a very inefficient cost structure. They've had relatively high administrative costs for the fund. They've had high debt costs. Again, interest rates have surged recently. They were fairly heavily leveraged. Farmland, it does pay yield, but the yields are a bit low on farmland, typically relative to other forms of real estate. And so for those reasons, their cash spreads have been quite weak in some cases. Also, they had a very costly lawsuit with defamation piece by someone who wrote against them, a short attack, and there was a lot of scandals with that, a lot of expenses, legal fees for the REIT that really weighed on sentiment and weighed on the fund itself. So those are all some of the reasons why FPI has had disappointing total return performance over the long term, and yet its dividend yield is also pretty low at just a little over 2%, which is quite low considering how cheap they're supposed to be. On paper, again, it's due to their high interest expense, due to their high administrative costs. And so, yeah, there's a reason why it trades at a discount. But management has a good plan for unlocking this discount. First of all, they are selling off properties. They recently announced a large sale of farmlands, non-core properties as well, so not some of their best crown jewel assets. And they're selling it, at close to or even in some cases higher than their own estimates of what the market value is. They're recycling those proceeds to two big things. One is paying down that debt, reducing their interest expense, paying down the high cost interest that's higher than some of the yields are on their properties that are actually reducing their cash flow. They're also using some of the proceeds to buy back stock, again, at this steep discount to its market price. And so the more they can do that, the more they're going to arbitrage, and the more they're actually going to increase the gap between the price and the NAV, assuming the stock price stays same. So that way they're forcing the market's hand, saying, hey, you must recognize the value of our underlying portfolio, or we're just going to eventually take ourselves private or be acquired by someone else at actually a value close to our underlying market value. So I think that's a great approach, especially when balanced with paying down debt. That's also important. Keep the balance sheet strong, improve their cash flow by reducing this high interest expense. Another thing they're doing is they are reducing their operating costs. They are making significant strides to reduce what they're spending on management teams and the corporate level to, again, improve their cash flow efficiency. This should also earn a better price from the market relative to their underlying value. And, they are also looking to exit California opportunistically. That's a part of their portfolio that's been plagued by some issues. If they can get rid of that or at least reduce their exposure there, that should also improve market sentiment. And finally, again, I like FPI just because it's a great portfolio diversifier. It's a bit of a safe haven investment at a time when gold, which is another safe haven I really like that has soared higher, much more expensive now. Farmland through FPI looks actually pretty opportunistic, especially if you think that interest rates are going to be coming down with the Fed cutting rates. It could really boost a stock like FPI. So I think there's a lot going for FPI right now. And for those reasons, I think it's a good buy. Okay, before I get into my second idea, if you could please subscribe to my channel, I'd really appreciate it. Help me grow my audience. Thank you so much. Okay, the second agriculture idea I really like is not the farmland play, it's the improving yields play. It's a crop nutrition stock. It's called Nutrien. It's ticker symbol NTR. It's one of the largest agricultural companies in the world, and it has really two businesses. One is where it produces crop nutrients like potash and other things like that. And then it also has a retail business where it sells agricultural products, including its own crop nutrients, through a retail system that generates quite stable cash flows. And so it has that two-tiered model, one that's very cyclical, that fluctuates with the price of the underlying commodities that they produce, as well as the retail business that generates much more stable cash flows. And it really uses that side of it to support its attractive dividend in order to make sure it's consistently generating cash flow through the cycle to support that dividend. It has about a 4.5% dividend yield right now. It's been growing its dividend every year at a rate roughly in line with or a little bit faster than inflation, depending on the year. So it's a dividend growth stock, pays a pretty nice current dividend yield. It also has been buying back stock quite aggressively. Moving forward, it's going to try to be more opportunistic in that approach. In other words, trying to make sure that they're buying when the stock price is cheap, which, by the way, I think it is right now. And so that's another way that they're going to increasingly create value for shareholders while still respecting the cyclical nature of the business, recognizing that at times they're going to have more cash flow than others, so they don't want to commit that part of the business to paying a dividend, because otherwise they may have to cut the dividend at some point. Instead, they can do buybacks, which are less of a commitment and more opportunistic in nature. Something else I really like about the business is that they're working really hard on improving their efficiencies. They're investing a lot in efficiencies of their mining operations to produce their materials. They're looking to exit and add parts of their retail business opportunistically through bolt-on acquisitions and strategic dispositions, again, to try to improve their profitability and their competitive positioning there. They also have an investment-grade balance sheet, which is obviously very important, especially when you're dealing with a cyclical business like NTR is. It's in a position where it should be able to support its dividend, buy back stock opportunistically, and invest in the business to grow it and improve its efficiencies over time without having to worry about their financial solvency. So there you have it. There you have two opportunities that both have been, their stock prices are down significantly recently. that have quality underlying assets and businesses. They pay out a decent dividend. They're both buying back stock aggressively. They both have good plans to unlock shareholder value over time. And again, they should both be boosted from these strong agricultural industry fundamentals that I mentioned at the beginning of the video. So hopefully this added value to you. If you like it, again, please give it a thumbs up, a like, subscribe to my channel. Let me know in the comment section below what you think of FPI and NTR, as well as any other agricultural businesses that you like. Thank you very much. See you next time.